We define value investing differently. We value a business and try to buy at a discount. That's our definition of value. Ben Graham, Warren Buffett's teacher, would say, figure out what something's worth, pay a lot less, leave a large margin of safety between them. That's our definition of value investing. It's not low price book, low price sales investing. Those are things that have traditionally rhymed with value, meaning if you're trading at a low price book ratio, a low price sales, your company's trading close to the historic cost of its assets, means it's more likely out of favor. And if you buy a bucket of those, you tend to find more than your fair share of cheap companies. That's a correlation. Causation are cash flows. We value businesses like we're a private equity firm. And so valuation of the business, that's what stocks are. They're not pieces of paper that bounce around that you put Sharpe ratios and Sortinos on or other fancy ratios. They're ownership shares of businesses that you value and try to buy at a discount. So whether the market rewards us for our valuations in the short term, we ignore, because that's what stocks are. I actually have taught at Columbia for 23 years, and I make a promise to my students first day of class. I promise them if they do good valuation work, the market will agree with them. Could be a couple of weeks, could be 2 or 3 years, but that is the secret, to have a steady, disciplined process to value companies and to be confident enough to stick with it, when it's not working in the short term. Market's very emotional in the short term. We try to ignore the noise. Stock investing is figuring out what a business is worth and paying less. And so that hasn't changed. What makes a company worth something and what makes it cheap relative to that. It's pretty straightforward. That's sort of Ben Graham. Figure out what it's worth, pay a lot less, leave a large margin of safety between those two. Warren Buffett added a little twist that made him one of the richest people in the world. He simply said, if you can buy a good business cheap, even better. If you read through Buffett's letters, it's very clear what he's looking for. First thing he's looking for anyway is businesses that earn high returns. We call it on tangible capital. And that just means every business needs working capital. Every business needs fixed assets. How well does it convert its working capital and fixed assets into earnings? So the example I used in the little book, which I really wrote to explain these kind of concepts to my kids, I said, imagine you're building a store and you have to buy the land, build the store, set up the display, stock it with inventory, and all that costs you $400,000. And every year the store spins out $200,000 in profits. That's a 50% return on tangible capital. Maybe I should open more stores. Not so many places I can reinvest my money at those rates. Then I compared it to another store. Remember, I wrote this for my kids, and I called that store just broccoli. It's a store that just sells broccoli, and it's not a very good idea. Unfortunately, you still have to buy the land, build the store, set up the display, stock it with inventory. That's still going to cost you roughly $400,000, but because it's kind of a stupid idea just to sell broccoli in your store, maybe it only earns $10,000 a year. That's a 2.5% return on tangible capital. And all I'd simply say is I'd much prefer to own the business that can reinvest its money, all things being equal, much prefer to own the business that can reinvest its money at high rates of return than much lower rates of return. And so that's sort of the Buffett twist that we incorporate in the companies that we invest in by being very tough on the way companies earn and spend their money. So we tend to get a group of companies that are not only cheap, but also deploy capital well. And that's really what we're looking for. So we've always done that. The little book was more of a way to systematize that. And I started it this way. I said, even Warren Buffett says that most people are better off just indexing. And I said, I agree with him. I didn't stop my lecture there. I said, but then again, Warren Buffett doesn't index and neither do I. How come? And it's because the opportunity is there, if you know how to value businesses, which most people do not, to take advantage of the fact that the market is emotional over the short term often. Well, it's pretty interesting from the research we did in the book. Most people know that the typical index funds, the S&P 500 and the Russell 1000, if you invest in those, they beat most managers, roughly about 70% of the managers. And that's pretty powerful. It's because of their low fees and that most managers aren't really adding value. So one logical thing to do would be to say, well, I know only 30% of the managers beat the typical index, so how do I find those guys? And it turns out if you look back over the last 3, 5, and 10 years of those managers' records, there's really no correlation between how they do in the next 3, 5, 10, which is really what you're trying to figure out. So that's why, many, at least advisors have recommended, and possibly rightly, that index funds for the individual investor who doesn't know how to pick stocks on their own is maybe a good opportunity for most people. So we set out to do something a little better. And as it turns out, the regular indexes, the S&P 500 or the Russell 1000, are seriously flawed, as it turns out. Even though they beat the most active managers, they're still very seriously flawed. And they do something that costs investors about 2% a year. And that really is that they're market cap weighted indexes, which means they put more weight into the larger market caps. So if you believe like Ben Graham or Warren Buffett that the market's sometimes emotional, it's not efficient like so many professors have professed over many years, it's not efficient. That means that if the market does get emotional over the short term, that some stocks are overpriced and some are underpriced. underpriced. And a market cap weighted index, if a stock is overpriced, it buys too much of it automatically. And if it's underpriced, it buys too little of it automatically because it's based on market cap, which is essentially price. It sounds crazy, but it actually is systematically doing the wrong thing at every point whenever there's an inefficiently priced stock. And so there's an easy way to correct that. And there are actually equally weighted indexes. Instead of putting more in the larger market cap companies, it actually puts an equally weight. So if you have the S&P 500, it'll put as much weight in stock number 1 as it will in stock number 500. It still makes plenty of errors. In other words, it's an equally weighting, but those errors are now random, not systematic like a market cap weighted index. So you actually get back the 2% a year. And a few people have come out with something called fundamentally weighted indexes. It's just another way to weight stocks without using price. And therefore, the errors in those indexes are also random, and you get back the 2% from those too. And since we're value investors and have done a lot of research on value investing over a long period of time, we created an index that we call value weighted, which just means the cheaper something is, the more weight we put into it. And it's actually more diversified than, the S&P 500 or a Russell 1000 index. Has the same volatility, has the same beta, yet over the last 20 years you would earn 7% more a year following that strategy. And it's ridiculously simple. Just put more weight in the cheaper companies.